Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
It's the stock valuation special. 2 weeks ago, we said we'd do an episode on valuation methods if viewers were interested. And after leaving many enthusiastic comments, it looks like you were. So here it is. In this episode, Greg and I tackle one of the biggest questions of them all. What is the stock worth? And how do you value it? Enjoy. Hello, I'm back. And welcome now to the 10th episode of What's Not Priced In. It's flown by. So it's obviously the 10 episode anniversary, and we have a 10th episode special for you guys planned. We've floated the idea, I think, 2 weeks ago, and you all kindly responded with enthusiastic comments. So today we're finally doing the valuation episode. And today's topic is obviously not about interest rates. It's not about inflation. It's not about tech stocks. It's not about NVIDIA. It's not about AI. Today is all about the fundamental and perennial question: how to value stocks. What are stocks worth? And obviously, what better person to answer that question than co-host Greg Canavan. Greg,
G'day,
welcome.
Kirill.
Well,
maybe what more annoying person to answer that question, because the answer is there's no right answer to the perennial question of how to value a stock. So we'll get into that, but yeah, that's the short answer to a long presentation.
Yeah, so basically that's the one takeaway. There is no one right way. But I think the way that you sort of do it is to focus primarily on return on equity, which basically measures profitability. So I thought we'd start right away. Maybe you can explain how you used to value stocks before you stumbled upon this approach, and why you sort of settled on this approach.
Yeah, it's a good place to start, because I suppose everyone needs to, and we've spoken about this before, everyone needs to find out what type of investor they are in order to have an approach that works for them. So some people are traders, some people just trade the charts and that fits their personality. Some people are more growth-oriented investors. They might like the tech stocks, and therefore they're trading trends and momentum, but they're doing so in a certain sector that they might understand. I have always been someone that has just, and like a lot of people, are attracted to the concepts of value investing. Value investing, I think, and we'll get into this because the formula that I use isn't really a value investing formula. It's just a stock valuing formula.
Yep.
It values growth stocks as well as traditional value stocks. But essentially, like many people, I went on the path of reading Warren Buffett, reading Ben Graham's Security Analysis, Intelligent Investor. And when I was in my, 20s, I just read loads and loads of books about investing and from investing legends. And there was always different ways that you could go about it. And your beloved dividend investing model that we're going to look at as well was a part of that. Discounted cash flow. But, there was always the question of, how do you account for this or that, or, what discount rate to use? Like, there's so many different inputs into or considerations when you're trying to value a stock, that all the sort of approaches that I used were always difficult or left me feeling a little bit, there's got to be something more. And I'm not even sure when it was, but a number of years ago, I stumbled across a book by Brian McNiven. And,
is it this one?
There you go.
Yeah.
Concise Guide to Value Investing: How to Buy Wonderful Companies at a Fair Price. Where'd you dig that out from, by the way?
I read your, it's a free plug. There's a Greg Canavan also has a book on valuation, and I read that when I started here in this company. And you obviously mentioned the book in your book, and then I just bought it. And here's your book there. You can get it on Kindle. I'm not sure if,
And it's appropriately blurred, and no one saw that. So there you go. but so that was the first time I saw this valuation model that I thought, okay, well, this is quite interesting. So, um, and then it went on from there. And then you sort of, once you use a model and you sort of learn what goes into it, then you can, because a model is only as good as its inputs, right? And I can give you any valuation you want by changing the inputs,
Yep.
and that's the uh, the interesting thing with valuation models. Whenever you read in the paper or whatever, someone values a stock at X, then they're not telling you what goes into
Mhm.
that valuation. Then you're left with a big question mark about what that is. So maybe the best way to explain this process is just to start off with a bit of a presentation I put together for this episode. So we'll start off with how to value stocks. There's no right way. There is no such thing as intrinsic value. Value is in the inputs. It's in the eye of the beholder. So
Yep.
depending on those inputs, you can come up with any type of valuation. And people would have probably heard this before. The valuation side of things is part science, part art.
Mhm.
So let's talk about the science first. There are three key inputs into the valuation process that I use. And the main one is the return on equity. The reason why this is very important and I think crucial is because the return on equity is effectively a profitability measure. So
Yep.
profits and profitability are two different things. And return on equity measures how well a company uses its equity capital. Uh, as a share market investor or as an equity investor, that is your investment dollars. So the equity capital is what you're concerned about, and a return on that equity capital is what you're concerned about. So return on equity is a very important consideration in a valuation model. The other thing that is very, very important is the required rate of return,
Yep.
and this is the discount rate. So put simply, a discount rate needs to be uh, a risk-free rate plus what's called an equity risk
Mhm.
premium. So the discount rate traditionally is considered to be the 10-year government bond yield. And in Australia at the moment, that's about 4%. And
Mhm.
an equity risk premium can be anywhere from 3 to 5%, and depending on the market's valuation and how the investors are
Mhm.
valuing things, there's an implied equity risk premium in the market. And at the moment, I think that implied equity risk premium is quite thin. And we talked about that in last week's episode with Romano. He made the comment that the
Yep.
equity risk premium was pretty thin. And just to let you know, and I'll show you how this works in a minute, but I generally use, for large cap stocks, I generally use a 8% discount rate.
Mhm.
And when I'm looking at small caps, I might go to 10%. But at the end of the day, it doesn't, if you've got a really risky stock and you're putting, say, 15% into the model,
Mhm.
it doesn't mean you're getting compensated for that risk, because the risky stock, it's not really about how much, how high your discount rate is. And just to be
Yep.
clear, the higher the discount rate, the lower the valuation.
Mhm.
So if you've got a really low discount rate, then you're going to get higher valuations out of it. So we'll go into that a little bit more. But just to finish off the key inputs into valuation, the other third thing that I don't see being used in many uh, models is the
Mhm.
dividend payout ratio. So
Yep.
essentially what this means is, if a company is paying out most of its profits in the form of a dividend, you're not going to get much of a benefit of the compounding effect of reinvesting earnings. So most people are familiar with the compounding effect.
Mhm.
That is, if you can reinvest money at a high rate of return, then that pile of money will grow relatively quickly. And that's the whole concept behind growth stocks. If growth
Mhm.
stocks are reinvesting all their earnings back into the business and generating a high rate of return on those reinvested earnings, then that stock is going to get a much bigger premium than a stock that is distributing all of its earnings via a dividend.
Yep.
So that's why the dividend payout ratio is quite important. So putting it together, the basic equation, and this is not including the dividend payout ratio. So this is just a really basic way of looking at two of the inputs. So you've got a return on equity and you divide that by your required rate of
Mm-hmm.
return. So just for ease of example here, let's say you've got a company that has a generating 20% return on equity. It's got your required rate of return is 10%. You effectively just divide the 20% by the 10% and you get 2. And what that means is you wouldn't pay more than 2 times the equity value, which is the book value of the business, to get your required return of 10%. So as I said, basic example. Does that make sense, Kirill? How does that sounding so far?
No, it sounds very good, and I think you've sort of mentioned that. And so, if people want more context, you go through those examples in your book as well, and you sort of start off quite basic and then add on the complexity. So, if anyone wants to get more info, you can just check out your book as well. But yeah, so far so good.
Okay, cool. So we'll go now to the full formula. So this is it takes into account reinvested earnings, and it's as we pointed out at the start from Brian McNiven's Concise Guide to Value Investing: How to Buy Wonderful Companies at a Fair Price. And if people want to jot this down or just keep this in mind, it's a bit of a formula, but it's pretty straightforward. It's effectively the return on equity divided by the required rate of return. But then what you need to do is break that return on equity up depending on what portion of it is reinvested into the business and what portion of it is paid out as a dividend. So this is the way that the model accounts for growth or accounts for companies that reinvest profits back into the business. So that very basic example I gave you of 20 divided by 10, that's effectively assuming there's no reinvested capital and it all goes out as a dividend. So in real terms, that means the balance sheet of the company or the equity value of the company is not expanding. Whereas this part of the full equation takes into account the reinvested earnings. So it's essentially return on equity divided by the required rate of return. Then you multiply that by the reinvested return on equity. And then you add the part of the return on equity that's paid as a dividend. So in the example I gave above of 20%, let's say there's a 50% dividend payout ratio, then you would multiply the first bit by 0.1, and then you would add 0.1 on the second bit, i.e. 10% in both parts. Then what you get as the answer is a multiple of equity. So let's say, for example, just go back to the other one. You've got 2 times book value is the estimate of value of the company. Then you would just get the book value per share of the company, multiply that by 2, and there is your valuation. So maybe that's all sort of conceptual. So let's do a real example. We've got Commonwealth Bank. These are estimates that are taken from consensus estimates that are using the current financial year, and we've only just gone into it. So they're sort of forward-looking estimates, but essentially this is what the market is starting to look at now. FY23 is behind us. So you really need to look at forward estimates. And for those who are wondering, what sources you can get that from, I think if you did Google searches, you'd probably be able to find forward estimates, on a free basis. But because I do this obviously all day, every day, I use a service called Market Scanner, and it's a global stock, I guess, data service that it's not hugely expensive. I think it might be $50 or $60 a month to use, and you can put in any stock code from around the world, and it gives you the financials. It gives you where there are analyst consensus estimates. It'll give you the next 2 to 3 years of consensus estimates. So you can do estimates of value based on FY24, FY25, that sort of stuff. So that's what I use. It's called marketscanner.com. Feel free to have a squiz. For Commonwealth Bank, the return on equity forecasts for this financial year is 13.4%. As I said, I generally use an 8% discount rate. Commonwealth pays a lot of its profits out as a divvy. It pays 75% profits out as a divvy, and that means it reinvests 25%. And it's got a book value per share of $44.70. So let's see what that looks like when we put it into the model. So you've got 13.4% as the return on equity, 8% is your discount rate or required rate of return. And maybe just before I go on, I probably should point out, what is a required rate of return? Let's assume the stock market doesn't exist, the stock market's closed, and you're just investing in a business. And that business is Commonwealth Bank, and you say, all right, I want an 8% return from this business. Now, I don't care whether the return is given to me in the form of reinvested profits or in the form of a dividend. Just add those two up and I want 8%. What price do I need to pay? So you're sort of, when you're talking about 8% required rate of return, you're talking from a business owner's perspective. Yep. What rate of return do I want? And then the stock market is another thing, and I explain that all in the book, hopefully quite clearly. But that's what the discount rate or the required rate of return is all about. So 3.35% is 25% of the return on equity, and that's the reinvested amount. So we're multiplying that first bit by the reinvested amount, then we're adding 75% of the return on equity, which is 10.5%. Then you divide that by your required rate of return, and your answer is 1.96 times book value. So if we multiply 1.96 times by the book value, which is $44.70, you get $87.61. Now, the current price of Commonwealth Bank is $104. So when I look at that, and I can put in a different discount rate just to see what the number would be, and my estimate is that the market is implicitly pricing CBA on a required rate of return of around 7%. So what does that mean? That means if you buy Commonwealth Bank for $104 and Commonwealth Bank hits those consensus estimates, i.e. it generates a return of 13.4%, then you're essentially going to get a 7% return, which will be mostly in the form of a dividend and slightly in the form of reinvested earnings. That might be fine for some. That might be fine for superannuation funds. Commonwealth Bank is a pretty solid company. But in my estimates, where I want a minimum of 8%, I wouldn't be buying Commonwealth Bank unless it got below $87. So that's just a very, as I said, we're not talking about the art of thinking about all the other things that go into consideration when you're looking at stocks. This is purely the science of valuation. So do you want to move on to Telstra now, or did you want to chat about that in any way?
Well, I was because Greg sort of has maybe a few gripes with the dividend discount model. I said that I'd also tried to do some valuations using the dividend discount model, and then maybe surprise you on the podcast just to see if our valuations using the same discount rate come close together.
Let's hear it.
And okay, well, drum roll. The value that I got for Commonwealth Bank using the dividend discount model was $93 a share, which was very close to your one of pretty much $88 a share. So
interesting,
very close, and so maybe it's not as bad a model as you think.
No, not at all. I guess that sort of works with dividend payers, right? Like if you've got a stock that's paying somewhere between 70 and 80% of its profits out as a divvy, that's a dividend payer. So I guess that model would work for it. The question I have, I'm not sure if you've got the data for this, but how does that factor in the growth of the reinvested earnings, or is there an assumed growth rate that you put into that model?
Yeah, so I think the very simplistic way that people can use this model particularly is usually the Gordon growth model, which is basically you get the forward dividends per share and you divide that by the product of the discount rate minus the stable growth rate. But there is more of a complicated way to get that stable growth rate, which actually uses return on equity, and which is also uses the reinvested growth rate. So usually, so when I got the 93 per share, I used Commonwealth Bank's estimated return on equity for full year 24, and I times that by the payout ratio. So basically, I just pretty much did what you sort of did there, and that gives me the implied growth rate of its stable earnings that's sort of reinvested, and then I plug that in, and
That's
I get that.
interesting.
Yeah. So that
What
model
was that
actually,
growth rate, by the way?
it was. Let me just get my notes out. So bear with me. Got my notes here. Yep. So just maybe for anyone interested. So if you want to use return on equity to find the growth rate using the dividend discount model, it's basically 1 minus the payout ratio, and then you times that by the estimated return on equity, which is similar to what you sort of do there. So the full year 24 payout ratio for Commonwealth Bank was, like you said, about 75%. The return on equity estimated was at 13.4. So you times the payout ratio and you times the return on equity, and you get a growth rate of 3.35%. And I think that's actually it right there in the formula as well for you too.
3.35. Fair enough.
Yep.
Look, I mean, it's interesting that they come out very similarly. I guess the thing that moves the value around the most is the return on equity estimate, right? So
Yep.
if I look at FY25 and I think the market's going to price ROE is going to expand again, then you'd sort of think, okay, well maybe the market's looking through a weak 2024 and is
Mm-hmm.
prepared to pay more for it because profits are going to rebound again in FY25. So what we're looking at really when we're valuing like this is just a snapshot
Yep.
of really where the stock is in the short term.
Yep.
So I'll often do a valuation for FY24,
Yep.
FY25 to get a sense of whether intrinsic value is expanding, is falling, and that gives you a better sense of where the market might be positioning. But as I said, this is more of the science behind the valuation. So it's just to give you an idea of how this model works.
Yeah, and I think
Um,
the most important thing, I think, with stock valuation, it really is probably leans more towards the art rather than the science, because anyone can use this formula or the dividend growth discount formula, but it's the inputs that really make all the difference, because all of these models are highly sensitive to the inputs. If you have garbage assumptions, you're going to get garbage results. So really, where all of the insight comes from and where the top players make the big bucks is by having accurate assumptions that go into the model.
Absolutely, and we'll talk a little bit about the art side of things
Yep.
at the end. But let's continue because we're going to do something similar with Telstra.
Yep.
Telstra's got a very high dividend payout
Yep.
ratio. It always has, really. It's a dividend paying stock. It's got a pretty good return on equity at 15.3%. So I guess another thing to consider here is the return on equity is essentially your net profit uh, divided by the equity base of the company. But sometimes net profit is different than free cash flow, and I consider free cash flow to be the more important uh, number to use. So there are some companies, and Transurban sticks out at me as an obvious
Yep.
one. There are some companies where the accounting profit is quite low,
Mm-hmm.
but the free cash flow that they generate is a lot higher. So you need to when you look at some companies and you think, why does that look so expensive? It's because the free cash flows are a lot higher than the accounting profit.
Mm-hmm.
And it's generally in your infrastructure type businesses that happens. So
Where the depreciation expense is really high.
Yeah,
Yep.
exactly. I found a company called Chorus, which is a New Zealand broadband provider, and I valued it based on its free cash flow, and it's considerably cheaper than what the valuation
Mm-hmm.
was just based on its net profit. So there are some companies where the market just doesn't value uh, net profit in the accounting sense, but looks at the free cash flows, because the free cash flow is essentially what is left over
Mm-hmm.
after sustainable investment needs, and therefore what is left over for payout as a dividend, reinvestment for growth opportunities, maybe buy back stock. That's the important number to look at. And there are limited companies where the free cash flow number is far more important than the accounting number. Telstra is one of those. There's not a huge difference between the free cash flow number and the accounting number, but I have used free cash flow here to get 15.3%, still using the required rate of return
Mm-hmm.
of 8%. And as I said, it's got a big divvy payout ratio of 95% and a book value of $1.40 per
Mm-hmm.
share. So when we do the numbers there, again, I won't go through all this, but it's pretty straightforward. There's your 5% of the 15.3%, and that's your 95% of the 15.3%. So my estimate of value using those inputs says you wouldn't pay any more than 2 times book
Mm-hmm.
value for Telstra if you wanted to get that 8% return from the business. Now, 2 times 140 is 280, yet you've got a current price of 425. Now, I recommended Telstra a couple of years ago around the sort of around this 280 level. Might have been a bit higher, around 3. Can't
Mm-hmm.
recall exactly, because it was might have been back in 2018. And I recently recommended clients sell this at around 420, and we took about 50% profit
Mm-hmm.
on it. But when I did the valuation on this, and the stock had rallied, it had done really well,
Mm-hmm.
given that we'd had a pretty rough market last year, and it sort of recovered. The market's obviously recovered, but Telstra has done really well. And I thought, it's getting to a price where the implied return you're getting from that business is just not all
Mm-hmm.
that good, and there's better opportunities elsewhere. So I recommend clients sell it. Of course, after that recommendation, I think it went up to 435, maybe even a little bit higher, but it's since started to
Mm-hmm.
come back down a little bit. And in my view, unless Telstra can start to really generate a higher return on equity and generate excess free cash flow, I think it's pretty stretched around this level. Now, the reason why people are liking it in this market is because you know
Mm-hmm.
it's almost a monopoly provider of mobile phone services. It's got the best mobile phone network in Australia. It's a good play on the inflation theme. It's got
Mm-hmm.
pricing power. So the market really likes it, and as a defensive company, it's very popular, and that's one of the reasons why I thought it was time to take profits. Whenever anything gets really popular and the valuation's just not there, I get a little bit worried. So based on this formula,
Mm-hmm.
you can work out and say the market is implicitly pricing Telstra on a required rate of return of around 5.5%. Now,
That seems very low.
well, especially when you can get
Yeah.
nearly 5% in term deposits these days, right?
Yep.
Which is risk free. So to me, that's just not a good risk reward trade off. And that's all you're trying to look for when you're valuing stocks. You're saying, okay, what's the risk? What's the reward? And if that's not a good equation, if it's not a good trade off, you don't need to be involved.
And I think that's what you were mentioning at the last week's episode about how the equity risk premium is so thin, especially if you look at Telstra's risk equity premium. It's tiny, and
Yep.
yeah.
Yeah. So you're essentially getting what 1.5% above the 10-year government bond yield
Mm.
to invest in. Yes, it's a solid business, but it's still a business that's impacted by uh, risks to the economy,
Yeah.
business risk, management risk, all that sort of stuff, regulatory risks. And is 1.5% enough of compensation for that? The simple answer is no, it's not.
No.
But right now, because the market is what it is, and these things change all the time. Like a few years ago, there was plenty of risk priced
Mm.
in to Telstra's share price, but now it's certainly not. So these are the sort of things you probably consider on the art side of things. But it is a pretty clear cut case of being pretty overvalued, I'd say.
Yeah. Well, I think if you wanted to know what the dividend discount model was saying, it was 250 a share, which was pretty much bang on to what your model was saying too.
So even harsher than
Yeah.
the my model.
Yep.
I guess that's maybe got something to do with a lower implied growth rate, perhaps, or
Yeah, I think if it's I think especially with Telstra, the implied growth rate has to be a bit lower. But I think also the great thing with your formula and maybe something like the golden growth formula is you don't necessarily have to use it to come up with your own valuation. You can literally just use it to figure out what the market is implying.
yeah,
And I think that's sort of this type of stuff that is maybe written in people like Expectations Invest in that book that sort of says you can use these discounted valuation models or the return on equity model to just figure out what the market is betting on. And then you can just work backwards and go, well, is that really achievable? Is that a reasonable thing? And then you can go from there. So I think if I plug in for example, with Telstra, if I use the Gordon growth model, I sort of and solve for the market's implied growth rate. It's very unreasonable, especially given that the Reserve Bank thinks that in June quarter 2025 GDP growth is going to be 2%, and Telstra's implied market growth rate is over 3%. So it's useful in that sense as well.
yeah, absolutely. And the way I guess you think about it is that when you're investing in stocks and you're projecting some sort of future
Yeah.
outcome, it's all about probabilities, right? No one's got any idea of what the next 6 to 12 months, 2 years is going to bring, and all you're trying to do is put the probability on your side. So when you do that and you look at a stock and you say, well, the implicit pricing on Telstra is a return of 5.5%.
Mm-hmm.
I don't know what the future's going to bring, but I don't like the sound of that.
Yep.
So I'm just, I'm going to take myself away from low probability
Mm-hmm.
situations and try to find higher probability situations. And that's really all you're trying to do with these valuation attempts. You're looking for good value and you're asking yourself, is this a good probability bet
Mm-hmm.
over the next 6 to 12 months? And when I say 6 to 12 months, there's probably a deliberate reason for that because the market in general is very short-sighted.
Mm-hmm.
So most, if you look at traditional valuation theory, a stock's market value is a reflection of its cash flows for years into the future. But what the market does is really gets, and especially when the market's bearish, the
Mm-hmm.
market gets very short sighted and will price in the next 12 months and not really worry too much about the next 2, 3, 4 years. So that's why in bear markets, you can pick up
Mm-hmm.
things at such good prices because the market has just become so short term in its looking at profitability. So it might say, okay, return on equity's fallen to 8%, even though that's based on a cyclical low. If you can buy that 8%,
Mm-hmm.
knowing that when the cycle turns, it'll go back to 10, 12, 14%, you're getting a very good price. The price you're paying for that though is just to sit there and wait
Yep.
while the market has its panic about are things going to get worse, and maybe they will get worse. But you can sort of arbitrage that demand by the market that it's looking very short term and say, well,
Mm-hmm.
I'm looking longer term, so therefore I'll just wait this out. But it's very hard to do because a lot of people are concerned about buying things that might go down more.
Yep.
We don't know the future, so we don't know whether earnings are going to get worse before they get better. So they're little, a lot of things that people have to consider. But it's one of the interesting things from my perspective that that's what you want to do. You want to sort of arbitrage that time
Mm-hmm.
difference where people are more focused on the short term and not necessarily focused on the longer term.
Yep.
All right, so let's go to a stock where the valuation doesn't work so well.
Yep.
It's a big stock. It's Apple. And I've written here, beware of big numbers, because the way that this model treats compounding, when you put really big numbers into it,
Yep.
it just creates crazy valuations. And so, for example, right, if we look at Apple for FY24, Apple has a return on equity of 157%. It's like a massive, hugely profitable
Yep.
business. And there are reasons for that, which we'll show you in a minute.
Mhm.
But if I put that into the model, and it's got a dividend payout ratio of only 15%, so it's reinvesting 85% of its profits back into the business, and then the model's saying, oh, okay, well, it's going to then generate 157% return
Yep.
on those reinvested profits, and it's going to keep doing
Yep.
that, it's going to spit out a crazy number, because the way compounding works, the higher the numbers get, the more crazy
Yep.
your number gets. So let's have a look at how crazy this would get. So just to round off there, it's got a book value per share of $4.70 US. So if we use consensus estimates for 24, the estimate of value is 330 times book value, which gives you a share price of $1,552 US. Now, the current price is $193. So clearly, that's an absurd.
That's a bargain.
Valuation. Well, yeah, I mean, Apple's just cheap, right? Which there is an argument that it is cheap, by the way. But we'll dig into that in a little bit. But it just goes to show you that the idea behind this model is you want to try and use sensible numbers, because the other aspect of markets and of capitalism is that when you have really high numbers, a competitor will see it and compete those numbers away.
Yep.
Now, whether that's going to happen for global tech companies that have found themselves with monopoly networks and massive global brands is another question, which is why, and we talked about this on our very first episode, that some of these stocks aren't necessarily as overvalued as what the market thinks, because they are hugely profitable. Yep. They've got cash piles. They're just generating extraordinary profitability.
Yep.
So putting these numbers into this model just doesn't work. So let's have a look at a different way to do it. So what I did is I assumed a more reasonable 70% return on equity, which is around what Apple was doing back in 2020. And I've assumed just a dividend payout ratio of 50%. So I don't want the model to go crazy on the compounding effect. So, and I just sort of guessed at these numbers, and because what I do a lot of times with stocks that are reinvesting momentarily, they're reinvesting all their profits in growth, I just assume a 50% dividend payout ratio, because what you've got to understand is when you put numbers into a model, that model just extrapolates that situation out. So if you're assuming 15% dividend payout ratio, that's assuming that year after year after year. And sometimes that's not a reasonable assumption, especially with some companies, especially in Australia. They might be reinvesting profits for the next couple of years, and then they might get to a level of greater maturity, and then they might change that and pay out. So I always go conservative and go for a 50-50 dividend payout ratio, because it just makes the valuation more conservative and makes sure that I'm not paying too much for a stock. So when we do that with Apple, we get a book estimate of value of 42.65 times book, and book value is $4.70, which gets us to $200 a share. So you can pretty much say the market is pricing in for Apple a sustainable long-term return on equity of around 70%. Now, I don't know enough about the company to know whether that's a fair assumption, but what I do know is that you can dig down into this return on equity by using something called the DuPont model.
Yep.
And this is really interesting because if you're looking at stocks and they've got a really good ROE, or even if they don't,
Mm-hmm.
but you want to know, how does that company generate that return
Yep.
on equity? Is it generated because they have a great brand? Is it generated because they've got a low capital base? And you can break it down to give you the nuts and bolts of
Mm-hmm.
what that ROE is made up of. And so the DuPont model allows you to do that. And what it does is you need to get the net profit margin. You multiply the net profit margin by asset turnover, and you multiply the asset turnover by the equity multiplier, and that gives you the return on equity. So what we're trying to do here is to look at how profitable is the business. What is the margin that the
Mm-hmm.
business is generating on their revenues? So just for example, if you're looking at, say, a food company like a Coles or a Woolies,
Mm-hmm.
you're going to get really low profit margins, but they're just churning
Yeah.
their stuff over and over. So they're getting volume on a low profit margin. Whereas Apple is probably a high profit margin business,
Yep.
still churning its assets over, but it's earning a big chunk of profit on revenue. And then the equity multiplier is really just a financial engineering thing. It's telling you how leveraged is the balance sheet
Mm-hmm.
and how much is that of that leverage is producing the return on
Yep.
equity. So what this DuPont model tries to do is says what portion of it is relating to the business and how the
Mm-hmm.
business is performing, and what portion is relating to the financial engineering the business that produces a return on
Yeah.
equity.
And I
So
think
if you've got
I think in your book you were saying that a high return on equity isn't necessarily always a great thing because companies can juice that number up with high debt levels. So, and I think DuPont is a great way to sort of break down the true sources of that high return on equity.
Exactly.
Yep.
Yep. Exactly right. So let's break it down and see what we get for Apple. So the net profit margin is 24.5%, which, it's not
Yeah.
amazing, but it's pretty
Yeah.
good. The asset turnover is 1.17 times. Again, it's good, but it's not necessarily amazing.
Mm-hmm.
But, it's probably reflective of the business. And what you want to do here as well is compare this to companies within the same
Yeah.
same sector, because each company is going to have different characteristics depending on what type of business it's in. So the real value from this comes from comparing different companies and seeing
Mm-hmm.
how they match up. So the equity multiplier, this is the really interesting thing for Apple, because Apple doesn't necessarily have a lot of debt, but its assets, it has 351 billion in assets, and it only has 63.9 billion of equity, which means its equity multiplier is 5.49
Wow.
times. Now that's pretty high.
Yep.
It implies that, well, essentially there's a lot of liabilities on the balance sheet,
Mm-hmm.
and the difference between assets and equity is liabilities. So it is a highly geared balance sheet. So when you multiply all those together, you can see here we're looking at the net profit
Mm-hmm.
margin multiplied by asset turnover multiplied by the equity multiplier,
Mm-hmm.
and that's where you get your 157% from. So what I did, I thought, okay, well, that's pretty high. The equity multiplier is pretty high.
Mm-hmm.
Let's see what Microsoft has as an equity multiplier. And it's only 1.89 times. Now,
Mm-hmm.
Microsoft's return on equity from memory is about 30,
Mm-hmm.
35%. So it's a lot lower than Apple's. But I thought if we do this formula and substitute Microsoft's equity multiplier, which is it's a far more
Mm-hmm.
conservative balance sheet, you come up with a ROE of 54%.
Yep.
Now, I didn't do a valuation based on an ROE of 54%, but if I did, the valuation would be lower than the current share price. So you'd probably look at it and say, okay, well, the current share price, it's not not outrageously
Hmm.
overvalued. I wouldn't say it's undervalued. Um, and there's a little bit of risk in there because the balance sheet
Yeah.
is relatively geared. So if, for example, I don't know, there was a flop in terms of one of the iPhone releases, or a competitor came up with some better stuff, and Apple started to struggle from a um, revenue and profit
Hmm.
perspective, then the leverage in that balance sheet would have quite an impact.
Yeah.
Whereas you don't have that with Microsoft. And I think I did the same for Nvidia, and Nvidia was only had a equity multiplier of
Hmm.
1.6 times as well. So yeah, you would say that Apple, and this surprised me as well, which
Yeah.
is why the DuPont method is really interesting,
Yeah.
because I didn't. My view was that Apple had a pretty solid balance sheet,
Hmm.
and I guess in many ways it does, but it's also gotten rid of a lot of its cash, probably through buybacks. I don't follow
Hmm.
the company closely, but I'd say it's buying back a lot of its stock, and that means that it's leveraging itself because it's returning
Hmm.
its excess cash to shareholders while maintaining liabilities that fund it through other means, and that's where you get this higher equity multiplier. So
Yeah.
yeah, I thought that was pretty interesting.
That's very surprising. I think that sort of shows the beauty of the DuPont analysis breakdown. It's sort of a little bit involved, but it definitely yields insights that are far deeper than the superficial stuff you can read on the news.
Yeah, 100%. And I don't do this with every single
Yeah.
stock, but I think sometimes when there's outliers, and especially when there's high return on equity stocks, I'll just have a squiz and just see whether there's anything that you need to be concerned about. Because often, like, I invested in this company, recommended this company to subscribers. It's probably last year or the year before, I can't remember. It was called Cymec, and it was a contractor, and it screened quite cheaply.
Hmm.
The model showed it was pretty cheap, um, but when you did the DuPont model, it had quite a high equity multiplier.
Hmm.
And even though it was cheap, and even though it looked really good from a valuation perspective, the market just didn't really want to touch it because
Hmm.
of the inherent leverage, and it wasn't necessarily high debt. So even if you looked at uh, net debt to equity ratios, it didn't necessarily show up.
Hmm.
The way that contractors are structured, they have a lot of liabilities
Hmm.
that aren't necessarily debt.
Yep.
So this is a really good way of highlighting this inherent leverage that's in a balance sheet. And often you can have a really cheap stock, but the market will just say, well, I'm not going to price that at a level that you would think is reasonable,
Hmm.
purely because there's too much risk in the balance sheet. And if business turns south, then the equity value of that business is going to, or sorry, the market cap value of that business is going to be hit because of the inherent leverage. So yeah,
Yeah.
that's why it's really interesting. And if you want to find this stuff out, you just type in DuPont ROE,
Yep.
and plenty of articles come up that you can get all the formulas from. Essentially, it's only 3 different formulas. Again, Market Screener's got all the data in there. Took me not very long to grab that out of that system. So
Yep.
beats trawling through annual reports to find it all.
Yeah, exactly. Well, I think now is the way to sort of round up the whole discussion and maybe find ways where the model maybe has some shortcomings or some disadvantages, and basically just reiterate the point that valuation is really more art than science. It's how you wield the tools, really.
Yeah, absolutely. And this is the really hard part, because if you
Yeah.
just value stocks and then go, oh, I found a cheap stock, I'm going to buy it. Yeah, you might get lucky. It might work sometimes, but it's not a consistent process that's going to deliver you good returns. So, and essentially, what you're doing with that valuation model, you're relying on consensus estimates, right? So, one of my first considerations, or things that I need to understand, is that those consensus estimates are probably going to be wrong.
Hmm.
And the
Yeah.
way that analysts work, they're just doing a job. They're plugging the numbers into their model, uh, but it's not good for anyone's career to be an outlier
Yeah.
when you're an analyst. You're not going to say, I think this company or I think the economy is going to turn down, therefore I'm going to price in a lower, a much lower estimate of earnings. Sometimes you get that. Like, for example, post-COVID, you've seen a lot of companies that have done really well during COVID, and analysts will price in a more of a normalization of their earnings post-COVID, which that makes sense, right? But essentially, I always say, okay, well, they're probably going to be wrong. So what do I want to do? I want to look for companies where the earnings have gone through a downgrade cycle. And there's two reasons for that. One, because you're not valuing a company based on, let's say, top of the cycle earnings. You're not valuing a company based on too much optimism, where a company might have done well for a couple of years and analysts are just like, this company's great. It's just going to keep doing this year after year. So I often look for companies that might have gone through a cyclical downturn. The analysts have downgraded the earnings. And once that happens, the analysts get burnt, companies get burnt. No one really likes the stock anymore because it's had earnings downgrade. No one wants to invest in a stock that's had earnings downgrades. But I think that's when you can at least have a little bit more confidence that those numbers are very conservative, because it's gone through the downgrade cycle. Could it get worse? Maybe. But you're buying essentially with a bit of a margin of safety. You're not buying top of the cycle earnings. And then to give me a sense of whether things could get worse, that's when I look at the charts. So, the charts will tell me if there is more bad news. Not all the time, but often the charts will say, look, just don't go near this. It hasn't finished its downgrade cycle. Whereas if there is still a lot of negative sentiment around a stock, if things are getting downgraded but the chart's looking better, then you think, okay, well, maybe the worst is over. Maybe everyone who wanted to sell is out, and now the value guys are coming in. And that was what happened with James Hardie. When I recommended that at the start of the year, it had gone through, I think it was 3 profit warnings. And I think on the 3rd profit warning, the share price actually went up. And I thought, okay, well, it's nearly all the bad news is priced in. If the share price has started to rally on bad news, then that's a good sign. So there are the sort of things that you try to think about and you try to look for. And the other thing is, I just don't invest in what I don't understand. So a good example is Xero, the accounting cloud software company. I tried to have a crack at it in, I think it was in March, when there was a bit of a broad sell-off in global markets after the Silicon Valley Bank tanked. And I noticed that all the tech stocks actually didn't really budge from that. And Xero was one that was looking quite strong on the charts. And I wrote a report and said, maybe this is the low for tech. And I've never been a good tech investor. Absolutely terrible, because I can't value tech stocks because they got earnings all the way out here. They don't even really have proper return on equities that you can put into the model. So I've got no basis for having a hand on heart way to say this is worth investing in. So I put it out there and said, look, let's keep an eye on the chart. We might invest in this, we might not. And sure enough, the share price spiked up, and I just stood there thinking, I don't really know what to do here, because the chart looks really good, but valuation wise, I got nothing. I'm not going to know when to sell. I'm not going to know when to take profits or whether to stick with it. So I just left it. And of course, I think it's gone up from 90 to 120 in the last few months. But it doesn't really bother me because I didn't understand it in the first place. And I think one of the key things is just don't invest in what you don't understand, because once you're in a stock that you don't understand, you're not really going to know what you're doing with it. And if it goes south, you might hang on in hope. Or if it goes up, you might take profits too early. It's just, there's plenty of other options out there where you do understand. So I'd say just stick to that. And just lastly, I would say that the key thing is just to understand the limitation of any model. So when you put a number into it, that can change all the time. And I always go back into market screener and look and see whether the forward forecasts have been changed and whether the numbers that I've based my valuation on are valid or whether they're not, whether the cash flows of a company are markedly different from its whether the free cash flows are markedly different from the accounting cash flows. There's always things that you can look at, and a model is only a model. It's just giving you a general sense of where things are, which is going back to the charts, is why I always like to combine that fundamental valuation with the charts, because the charts are effectively telling me what the psychology behind the stock is. So if you can match those two things up, you don't necessarily need to be 100% on the valuation. If the charts are giving you confidence, you can be 80% on the valuation. And you say, well, that's, again, going back to probabilities. Am I putting the odds on my side? Tick a box. Yeah, I've got reasonably good odds here. If I'm wrong, I'm not going to be blown up. If I'm right, there's probably a good amount of upside. So yeah, it's really just sort of saying to yourself, okay, this is a model only. It's giving me a guide. It's trying to put some probability on my side, but it's never going to be 100% certain. And certainly if a company comes out with a profit warning, it's going to blow that model up anyway. And you have to put some numbers in and then be shocked at the change, because they can change quite vastly from, especially, smaller stocks. And I've never been a great small cap investor, which is why I focus on the large caps. So yeah, I think that's about it.
Yeah, that was very comprehensive. I certainly enjoyed it. I think hopefully everyone else enjoys it. I think some takeaways that I took from it is, obviously the model is only as good as its assumptions. So that's the art part of it. The science is the model, but the art is the assumptions. Also, you don't really have to swing at every idea. I think that's the Buffett quote. Just pick your spots, and that's why, with zero, it could have been a good idea, but you didn't really have to swing at it. There'll be other opportunities. And I think there was another one, but I already forgot it. And
just on that point, I was just finishing up a report for my readers today, and I was listening to a podcast on the weekend, and the guest was Peter Atwater, which is he's a behavioral economist, and it was just quite timely, because I was thinking, okay, what am I going to tell my subscribers this month? And normally I recommend a stock a month, and you do your research and you come out with an idea, but the market's just been running for the past month, right? Like just about everything has gone up, and if it hasn't gone up, then maybe you don't really want to be touching it. And I was thinking, I don't think you have to do anything. You just don't have to do anything this month. And I wanted to write an article about, here's some ideas that I've got, but let's just sit back. You don't have to take them now. Let's sit back and wait and see how things play out in the next couple of months. Because one of the things we talk about here a lot is sentiment, right? The CNN Fear and Greed Index is still, well, I think it's been nearly the length of the 10 episodes. It's still on extreme greed, which is crazy. And just general retail investor sentiment indicators are now at the highest level they've been since April 2021. So we're getting to these sentiment extremes, even though the fundamentals are not really improving. So anyway, so Peter Atwater, this behavioral economist, made a comment right at the end of it where the host asked him, what would be your advice to people? And he just said, you don't need to do anything. You don't have to act. There are times where you can just sit back and observe. And I think that's a really important thing, that just because a model tells you to buy, or just because it feels like everyone else is buying and stocks are going up, do I need to jump in there and do that? You don't. And I think once people become a little bit more comfortable with the process that they're following, who they are as an investor, what understanding themselves as an investor, those decisions become a little easier. But if you've got money burning a hole in your pocket and you're thinking you need to do something with it straight away, that's when you can tend to get into a bit of trouble.
Yeah, it's a bit like the marshmallow test. You don't have to always eat the marshmallow straight away. Just hold off, and maybe you can get 2 marshmallows.
Hold off, and you'll get 2.
Yeah, exactly. Well, thank you, Greg. That was highly informative. And if you guys enjoyed it, definitely leave a comment. We read all the comments, and we certainly enjoyed reading the positive comments a few weeks ago. And let us know if you want us to cover anything else.
Yeah, comments are great, so keep them coming, please.
Yep. Okay, well, see you guys next week.
Cheers, guys. Thank you.
See ya. Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.